Hello, everyone. What if the biggest threat to your trading success isn't the market at all? What if it's you? Behind every chart pattern and price move, there's a hidden battle taking place inside the minds of traders. Fear, greed, panic, euphoria. In the psychology of trading, Dr. Brett Steenbarger dives deep into the emotional and psychological forces that silently make or break fortunes. This isn't just another trading book. It's a raw exploration of real traders facing real demons, with life-changing insights that could transform how you think, feel, and trade forever. Get ready to uncover the truth most traders ignore, their own mind. Before we dive deep, don't forget to like, share, and subscribe for regular content on trading psychology, success habits, and untold stories behind the charts. Let's begin with Chapter 1, The Woman Who Could Not Love. She was a successful trader on the outside, disciplined, intelligent, and logical. Her track record was solid, and she followed her trading system with great precision. Yet, something was missing. There was a coldness in her behavior, a distance she maintained from her trades and the people around her. She treated losses and gains the same, showing no signs of being emotionally connected to her performance. Her trading wasn't failing, but it wasn't growing either. There was no evolution in her style, no innovation, no fire. It was as if she had built a wall between herself and the market. In sessions, it became clear she didn't trust emotions. She believed they were distractions, unreliable and dangerous. She worked hard to keep feelings out of her decisions. This mindset had roots far beyond trading. It reached into her personal life, where she struggled with intimacy and connection. She avoided relationships, kept people at a distance, and maintained a sense of control by being emotionally detached. This same mindset had carried into her trading. Her trades followed a rigid process. She relied on numbers, patterns, and checklists. She had trained herself to avoid excitement, fear, or disappointment. But this detachment came at a cost. She wasn't responsive to changing market conditions. She stayed locked into setups, even when new information suggested otherwise. When asked about how she felt during trades, she often said she felt nothing. This wasn't calmness. It was a form of emotional numbness. As the work continued, her trading history revealed a pattern. She often missed opportunities where a little intuition or risk-taking might have led to significant gains. She exited positions too early, unwilling to hold through uncertainty. She avoided trades that felt too aggressive, even when analysis pointed in favor. Her system was built to keep emotions out, but it also kept growth out. She wasn't making mistakes in a traditional sense. She was limiting her potential by keeping everything safe. Exploring deeper, it became clear her early life had shaped this approach. She had grown up in a household where vulnerability was unsafe. Expressing feelings brought punishment, not support. Over time, she learned to suppress emotion as a survival tool. This suppression became part of her identity. In her mind, to feel was to lose control. To love was to invite pain. Trading became a perfect arena to express this worldview, structured, controlled, and emotionally neutral. But markets are dynamic. They breathe, shift, and evolve. The best traders adapt, sense, and feel subtle changes. They use emotion, not as a guide, but as a signal. Fear alerts them to risk. Excitement shows opportunity. The goal isn't to remove emotion, but to understand it. Her trading needed this flexibility. She needed to reconnect, not just with emotion, but with the part of herself that had been shut off long ago. To begin this process, her sessions introduced small exercises. Instead of avoiding feelings, she was asked to notice them. She kept a log, not just of trades, but of emotional responses during the day. What did she feel when entering a position? What did she feel when holding? What emotions arose when she exited too early? The goal wasn't to fix these emotions, but to acknowledge them. She also began journaling outside of trading. Each morning, she wrote freely about anything that came to mind. No editing, no rules. Over time, these journals revealed patterns, recurring doubts, old fears, and suppressed desires. Slowly, she began to understand how her emotional detachment wasn't strength, it was armor. In time, her trading started to shift. She became more curious. She allowed herself to explore trades outside her rigid setup. She stayed in positions longer, learning to trust her process and tolerate uncertainty. She began reviewing not just what went right or wrong in trades, but what she had felt during them. This added dimension gave her new insight. Emotion wasn't the enemy, it was information. She even allowed herself to take breaks from trading, not out of fear, but out of awareness. She started building relationships, both in her personal life and within trading communities. She sought feedback, shared ideas, and opened up about struggles. This willingness to connect mirrored her growth as a trader. Eventually, her performance improved. Not dramatically, but steadily. She didn't just gain more profits, she gained more perspective. She stopped seeing the market as something to control and began experiencing it as something to engage with. Her trading became a reflection of a deeper truth. Chapter 2. The Student Who Wouldn't Study. He came into the office with confidence in his eyes and a good trading record behind him. But as the sessions began, something odd became clear. He wasn't growing. Despite his potential, his development was stuck. He wasn't reading trading journals. He wasn't backtesting new setups. He wasn't reviewing charts before market open or journaling trades after market close. His trades were impulsive. He entered positions without clearly defined rules or preparation. The strategy he once followed with discipline had turned into instinctive action, guided more by feeling than by planning. As questions dug deeper, it became clear that his reluctance to study wasn't laziness. It was something older, more rooted. In school, he always managed to get by on natural ability. He never needed to study for exams, and when he did, the results didn't always improve. Over time, he developed a belief: studying doesn't pay off. It only wastes time. That belief now followed him into trading, even if he didn't see it. His trades were not supported by consistent analysis, and he rarely looked back at what went wrong. Without this feedback loop, he was running blind. To understand and change this pattern, the first step was awareness. He began by keeping a detailed journal, not just of trades, but of thoughts before, during, and after trades. He wrote about the logic for each entry, what indicators he used, what patterns he saw, and why he exited when he did. It was uncomfortable at first. He didn't like confronting his thought process, especially when it was unclear or rushed. But slowly, the act of writing forced him to think. It slowed him down, made him ask himself hard questions. Why did I take that trade? What was my edge? What went wrong? Did I follow my plan? After 2 weeks of journaling, patterns started to emerge. Many trades had no setup. Some were revenge trades. Others were chasing. Entries came from fear of missing out. Exits came from panic. The data didn't lie. He saw the gap between what he believed he was doing and what he was actually doing. That realization gave him control. With control came the ability to change. He began setting specific goals for each week. Not goals like make this much money, but process goals. Review charts for 30 minutes daily, study one historical setup per night, summarize each day's market behavior in a sentence. He made it measurable. He turned study into routine. Once the habit formed, he saw progress. His trades became more selective. Entries were backed by analysis. Stops were planned in advance. Losses still happened, but they no longer triggered spirals of emotion. Wins came from structure, not luck. To reinforce the behavior, he added a layer of accountability. He sent weekly performance reviews to a mentor. Each review had a scorecard, rating him on trade planning, risk management, emotional control, and post-trade review. The scores weren't about punishment. They were feedback, a mirror showing him where he was sharp and where he was slipping. Over time, the numbers improved. He felt more in control, not just of trades, but of his process. At one point, the market turned volatile. Others panicked, but he stuck to his plan. He had studied the behavior of the market in past volatility. He knew what setups tended to work. He narrowed his focus and increased position size only when the edge was clear. The preparation gave him confidence. The trades came from clarity, not impulse. As months passed, studying wasn't a task anymore. It was part of the process, like brushing teeth. He reviewed the market every morning. He kept detailed records of each trade. He held himself accountable not just on results, but on execution. His growth didn't come from trading harder. It came from trading smarter. The transformation wasn't dramatic. It didn't happen in a day. But step by step, he shifted from an intuitive trader to a disciplined one. He built a foundation of knowledge that could support his decisions in all kinds of markets. When a trade failed, he knew why. When it worked, he could replicate it. He learned that natural talent wasn't enough. In trading, talent fades without structure. Success depends not on what you feel, but on what you know, what you prepare, and how you respond. And all of that begins with the decision to study. Not for school, not for show, but for the craft itself. Chapter 3. The Woolworth Man. He was known simply as the Woolworth Man, an older trader, calm in his demeanor and not particularly flashy. His style of trading had a sense of rhythm and consistency. He came from a time before trading platforms became high-speed machines. His background wasn't rooted in computers or coding, but in retail. Years spent behind the counter at a Woolworth store had trained him in observing people, reading moods, and understanding the psychology of behavior. That observational skill, which once helped him understand what customers wanted to buy, now helped him read the market. He didn't use charts filled with indicators. He didn't rely on elaborate models. Instead, he watched price movement with focus, almost like how he once watched customers scan the store shelves. He was drawn to patterns in price action, particularly to what traders now call market structure, how prices react around support and resistance. His mind naturally logged repetitive behavior. He didn't need elaborate systems because his edge came from observing how others acted when fear or greed pushed them too far. His trades were not frequent. He waited until a pattern repeated itself enough times that he could trust it. He would then enter his position calmly, always with a fixed stop, always with a clear target. He sized his trades modestly. He didn't chase profits, and he didn't panic over losses. Over time, his results were steady, never explosive but always growing. His strength was consistency, not complexity. He mentored a younger trader who approached the market differently. This new trader had a strong academic background. He built models, tested systems, and focused on statistical probabilities. His monitors were filled with data feeds, price projections, and scripts. He believed in algorithms. He often looked at the older trader's methods and dismissed them as outdated. The older man didn't even know how to use half the tools available today. Yet month after month, the Woolworth man would end in profit, while the younger one often broke even or worse. Eventually, curiosity led the younger trader to ask questions. He wanted to understand what made the older man succeed with such simple tools. That's when he learned that trading wasn't only about tools, it was about pattern recognition, discipline, and emotional steadiness. The Woolworth man didn't care what caused the move. He cared how people responded to the move. When prices moved too far too fast, he looked for exhaustion. When they stalled near key levels, he looked for signs of accumulation or distribution. He didn't trade headlines. He ignored earnings calendars. He had no need for breaking news because he believed that everything important was already reflected in price. He trusted his observations more than opinions. He would sit for hours and just watch. No trades, just watching. He believed that preparation didn't always come from doing something. Sometimes it came from learning to do nothing. The younger trader decided to experiment. He turned off the news feed. He simplified his screen layout. He started focusing only on price and volume. He began to log recurring behaviors: how markets opened, how they moved in the first 30 minutes, how they closed near the end of the day. He watched closely how prices reacted around previous highs or lows. He began to understand market behavior the way the older man did. With time, the younger trader started to trade fewer setups, but more confidently. He stopped overtrading. He began to wait. He noticed how the urge to trade constantly faded when he truly started to understand what he was looking for. He realized that price action could tell a complete story without needing a single indicator. Eventually, he blended both styles. He used models for structure and planning, but relied on pattern recognition and observation for execution. The lessons he learned couldn't be found in any book. They were passed from a man who once sold goods across a wooden counter, but had developed an intuitive eye for what markets were truly doing. In the end, what stood out was not the system, not the speed, and not the software. What stood out was the ability to observe without distraction, to wait without frustration, and to act without hesitation. The Woolworth man never bragged, never rushed, never chased. He simply stayed with what worked, repeated it with care, and let the market reward him with time. The younger trader learned that real growth in trading often comes not from doing more, but from doing less with greater focus and deeper understanding. Chapter 4. Traders Out of Their Minds. A young trader sits in front of his screen, filled with confidence. He feels on top of the world. He makes one trade, then another, and both go well. He increases his position size. He tells himself he's found his rhythm. In his mind, he's unstoppable. His profits soar. He believes he's seeing the market in a special way. He ignores small signals of trouble, convinced he can handle any pullback. Then a large position turns against him. He holds it. He adds to it. He tells himself it's only temporary. But the market keeps falling. His losses grow. The screen flashes red. He can't stop watching. He feels trapped. And then, in one final move, the account is wiped out. This wasn't a lack of skill. It was mania, a psychological shift that caused overconfidence, impulsive decisions, and a loss of risk control. When people experience elevated moods, their thoughts become rapid, their judgment impaired. They believe they're more capable than they are. In trading, this leads to excessive risk, ignoring stop losses, and chasing after the market with no limits. The result is often catastrophic. There's also the opposite, a trader who wakes up feeling heavy. He opens the trading screen, but feels no energy to act. Every trade looks like a potential loss. He hesitates, overthinks, and misses opportunities. He tells himself he's just being cautious, but inside he feels hollow. His sleep has been off. He's been skipping meals. Slowly, his self-worth ties itself to each small gain or loss. When trades don't work, he feels like a failure. He stops trading altogether. This is not a case of poor market knowledge. It's depression taking hold. It dulls motivation, slows thinking, and erodes confidence. The mind focuses only on the negative. What could have been an ordinary drawdown becomes a personal crisis. In another case, a trader starts the morning calm, but the moment he sees a losing trade, his heart races. He tightens up. He double-checks every tick. He exits trades early, afraid to lose more. Even winning positions are cut before their time. He's not trading the market anymore. He's trading his own fear. Each session becomes a battle not with price, but with panic. His palms sweat. His breathing changes. He feels frozen when he should act, and acts impulsively when he should pause. This is anxiety disorder in action. The brain scans for threats, and any small loss becomes exaggerated. It's no longer about strategy. It's about survival. There's also obsessive behavior. A trader spends all night backtesting systems, checking forums, comparing indicators. He jumps from one strategy to another. He needs everything to be perfect before taking a trade. If something is out of place, a line on a chart or a number in a report, he can't focus. He delays action, not because of lack of clarity, but because of an internal demand for control. This is obsessive-compulsive thinking. It creates rigid expectations and paralyzes decision-making. The market doesn't provide perfect signals. It moves in probabilities, but this trader can't accept uncertainty. So he waits and rarely acts. Sometimes, trauma plays a role. A trader may have suffered a major financial loss in the past, maybe a blown account or a failed investment. That memory sits in the background, always present. He fears repeating the same mistake. Every trade feels like a test of safety. He second-guesses himself. If he loses, he overreacts. If he wins, he can't enjoy it. He may even avoid placing trades altogether. This isn't a lack of technical knowledge. It's post-traumatic stress. The mind links past pain with current risk. It replays scenes from before, even when they don't apply now. And so, the future becomes shaped by the past. In each case, the trader is not irrational. Their thoughts follow patterns. The problem is those patterns are being driven by emotions and mental states that are out of alignment. Just as a person with a fever doesn't think clearly, a trader with mental health imbalances struggles to stay focused and objective. Understanding these patterns is the first step to regaining control. It's important to recognize that not all trading struggles are solved with better strategy. Sometimes the problem lies in the mind. Seeking help, building self-awareness, and managing emotional states are not signs of weakness. They're signs of strength. The market rewards clarity, discipline, and adaptability. When the mind is balanced, decisions follow smoothly. When it's not, no amount of technical skill can make up for the chaos within. Trading success is not just about what's on the screen. It's also about what's going on in the mind behind it. Chapter 5. Mary, quite contrary. Mary was a trader with sharp instincts and impressive knowledge of the markets. She had a good track record, and her trades were often based on well-researched strategies. But something strange kept happening. Every time she entered a trade and it started to go in her favor, she would pull back. She would either exit too early or move her stop-loss closer, tightening it beyond reason. If the trade moved against her, she would wait too long to get out, hoping it would turn around. Despite knowing the probabilities, despite having the data, Mary kept doing the opposite of what her own logic told her. She micromanaged her trades in ways that contradicted her planning. Her actions weren't aligned with her strategy. The problem wasn't her trading system. She had already tested it, and it worked. She knew the entry and exit signals. She knew her risk-reward ratios. What she struggled with was the ability to follow through. Every time a trade was live, she would monitor it minute by minute, almost tick by tick. She couldn't help but interfere. The slightest pullback would cause her to doubt. Instead of letting the trade breathe and giving it space to develop, she would get in the way. Her issue wasn't simply overtrading. It was an inner tension that made her unable to trust her process. She believed she needed to be in control of every move. She didn't feel comfortable handing over control to the system, even though the system had already proven its worth. The result was that her outcomes were inconsistent. Profitable setups often turned into tiny wins or losses because she cut them short. Trades with poor potential dragged out longer than necessary because she hesitated to admit they were wrong. Her emotions interfered with her ability to follow her plan. To understand this pattern better, it became important to examine her decision-making style. She approached most situations by anticipating problems in advance. She was the type of person who tried to prepare for everything that could go wrong. That mindset helped her avoid surprises, but also kept her from letting go. She treated trading like a series of small emergencies rather than a flow of probabilities. Her strength in preparation turned into a weakness when she couldn't allow events to unfold without trying to control them in real time. The solution began with awareness. She needed to observe her actions without trying to change them immediately. By tracking her trades, she was able to note how often she interfered with winning trades compared to losing ones. She realized she was much more likely to intervene when she was in a winning trade. That insight was important. It showed that her discomfort with success was stronger than her fear of loss. Her identity as a trader had become tied to avoiding mistakes rather than achieving profits. Next, she began to build routines around attachment. Instead of staring at her screen during every trade, she practiced setting alerts and walking away. This small act of stepping away reduced her temptation to react emotionally. Over time, she also started reviewing her trades after the market closed, rather than during active hours. This helped her evaluate the trades based on logic and strategy, not the feeling she experienced in the moment. It shifted her attention from short-term control to long-term consistency. She also created scripts to rehearse before each trading session. These scripts reminded her of the key signals she would trust, her risk limits, and the fact that some trades would win and others would lose, regardless of how closely she watched them. By repeating these scripts, she reinforced the mindset that successful trading is about process, not perfection. The repetition helped make these ideas part of her thinking, especially when she was tempted to interfere. As Mary kept practicing these techniques, she noticed her results improving. Her profitable trades were running longer. She wasn't exiting just because of temporary discomfort. She still had losses, but they were according to plan and not from panic or hesitation. She was finally trading according to her method, not her fear. The more she trusted her process, the more confident she became. She stopped trying to avoid discomfort and instead focused on doing what the plan required. Her journey was not about learning a new trading system. It was about aligning her actions with the one she already had. The turning point came when she understood that managing herself was the real task, not managing every tick of the market. By stepping back, she stepped into her role as a trader in control of her process, not a prisoner of every price movement. Her edge didn't just come from the charts. It came from her ability to stay true to the plan she believed in. Chapter 6: The Evil Spiders. She came into the office with fear crawling through her voice. Not fear of the market, not fear of losses, but fear of something deeper, more invisible. Something that kept showing up at the worst times, moments before pressing the button to place a trade. She called them the evil spiders. They weren't real, but they were real enough to make her heart pound, her hands shake, and her mind go blank. It had started long ago, back in childhood, with fears planted by a strict father and reinforced by a chaotic household. But now, those fears had grown legs and started crawling into her trading. She could do fine in simulations. When there was no money on the line, her strategies worked. Her setups were sharp. She had the skills, she had the edge, but when the real trade approached, when real money was at stake, the spiders came. Thoughts raced in her head. What if the trade goes wrong? What if I lose everything? What if this time is different? What if I'm exposed? What if I fail? Each time she tried to silence them, they grew louder. The fear of being wrong paralyzed her. She couldn't enter trades with conviction. She would hesitate, miss entries, chase price, and then exit too early or too late. It wasn't about the charts anymore. It was about surviving the mental noise. She was taught to stop fighting the spiders directly. Fighting fear often feeds it. Instead, she began with simple breathing exercises, slowing her breath down, feeling it move through her chest, calming the nervous system just enough to pause and observe. With every breath, she would say to herself, "Notice the fear, but do not become it." She was instructed to become a watcher of her thoughts, not a prisoner to them. Each morning before the market opened, she wrote in a journal, not about her trades, but about her thoughts. She listed her fears, gave them names, drew them on paper, labeled the loudest ones, gave them shape and size. This gave her control. When she saw them clearly, she could talk back to them. She'd write responses like, "Yes, I may lose, but I have risk controls," or "I have survived losses before." Slowly, the spiders became less powerful. In live trading, she was coached to take tiny positions. Not full trades, just practice entries. She didn't need to win. She just needed to act in spite of the fear. She made a rule: act before overthinking. Enter small. Focus on the action, not the outcome. This exposure to the act of trading, again and again, helped break the link between fear and paralysis. The mind adjusted. Her brain no longer saw the trade as a life or death event. Visualization became part of her morning routine. Before markets opened, she sat quietly, closed her eyes, and imagined the entire day play out. She saw herself noticing the fear, letting it pass, placing the trade with calm breath, managing it with discipline, exiting with clarity. The more she visualized, the more familiar those moments became. Her brain began to trust that she could handle discomfort. One afternoon, during a particularly volatile market day, she noticed the fear begin to rise again. The same old thoughts started creeping in. But instead of resisting them, she smiled. She took one breath, then another. She labeled the thought spider and gently let it go. She focused on her process, her entry rules, her stop loss, her targets. She placed the trade, managed it, closed it. It wasn't perfect, but she had done it without panic. And the spiders, this time, didn't win. Her daily structure became tighter. She began every day with breath work, visualization, and journaling. During market hours, she kept a checklist next to her screen, not just for setups, but for her mental state. If fear rose above a certain level, she took a break, stepped away, breathed, and returned with clarity. Her self-awareness became a tool just as important as technical indicators. Over time, the spiders lost their strength. They still visited, but now she saw them for what they were: old shadows from another life, not truths about her trading. Her process matured. Her execution sharpened. Her confidence no longer depended on outcomes, but on her ability to stay calm and follow through. The fear didn't disappear, but it stopped controlling her. She didn't defeat the spiders by force. She outgrew them by turning on the light. Awareness, routine, preparation, and small courageous actions taken one trade at a time. And in doing so, she reclaimed her power, not just as a trader, but as a thinker who no longer let fear decide her future. Chapter 7. The Big Man Beneath the Bed. The story begins with a trader named Martin, a man in his early 30s who had shown great analytical skill and had built a promising career in trading. He had a solid understanding of the markets and had developed a strategy based on strong fundamentals. Despite his preparation and knowledge, there was a recurring problem. Every time Martin faced an important trading decision, particularly when large sums were involved, he would freeze. His heart would race, his mind would flood with what-ifs, and he would either exit too early or avoid placing the trade altogether. This wasn't due to a lack of knowledge or preparation. Something deeper was at play. Martin described the experience as being haunted by something he couldn't explain. He said it felt like there was a big man under the bed, waiting to grab him whenever he got too close to risk. It was an old feeling, not new to trading, and it always came back during moments of high pressure. What made this more concerning was that it didn't just affect his trading. It bled into other parts of his life. When under pressure in his personal life, Martin also avoided decisions, pulled away, or chose inaction. To understand what triggered this paralysis, a deeper exploration was needed. When Martin was asked to recall a time in his childhood that involved strong fear, he talked about an experience from when he was 6 years old. He remembered hiding under his bed while his parents argued loudly in the other room. It had happened often, and each time, he felt small, scared, and helpless. Over time, hiding became his way of coping. When the yelling started, he crawled under the bed, curled into a ball, and waited for it to end. That memory of being trapped and helpless stayed locked inside him for years, buried but never forgotten. As an adult, this childhood experience had not gone away. Instead, it had attached itself to new situations like trading, where Martin faced uncertainty and pressure. Though the source was different, the body and mind reacted the same way. The moment uncertainty appeared, Martin's brain went into a defensive state, as if trying to protect him from danger that wasn't real anymore. He wasn't hiding under the bed anymore, but the fear had never left. To work with this, Martin was guided through a process called decatastrophizing. This involved identifying the fear, examining the worst-case scenario, and rating how realistic or likely it really was. For example, when Martin feared losing money on a trade, he had to break down what the actual consequence would be. Would he be ruined? Would he have a job? Would he lose everything? When he looked at the facts, he realized that none of these outcomes were likely, especially when he followed his risk management rules. Another step was building a script that Martin could use when fear started to rise. This script included questions that helped him get out of the fear zone and into logical thinking. Questions like, what's the setup? What are the odds? Where's the stop? And what am I risking? By repeating this during trading moments, he began training his mind to shift from fear to focus. Martin also started using imagery. He visualized himself staying calm during a trading session, even when the market was volatile. Each time he did this, he imagined breathing steadily, following his plan, and sticking to the process. He didn't try to remove the fear entirely. He accepted that it was there, but chose not to let it control him. Over time, the image of the big man under the bed lost its power. Another technique used was called exposure. Martin was asked to do practice trading sessions in conditions that mimicked the stress of real trading. The more he placed trades while feeling the fear but not giving into it, the more confident he became. He began to trust that fear didn't mean danger. It was just a signal, and he didn't have to obey it. Gradually, Martin changed his relationship with risk. He didn't have to feel safe before acting. He learned that waiting for perfect comfort often meant missing the opportunity. Instead of aiming for zero fear, he aimed for action with fear present. With repetition, the old associations began to fade. What once felt like danger became just another part of the process. In time, Martin was no longer paralyzed when the pressure built. He still felt tension, but it no longer froze him. His trades became more consistent, not because his strategy had changed, but because he had. The big man beneath the bed didn't disappear completely, but Martin stopped hiding from him, and that made all the difference. Chapter 8. Buried Alive. A trader sat in his quiet office, the screens in front of him glowing with red numbers. The market had taken a sharp turn, and with it, his account had been heavily drained. The drawdown wasn't small. It was massive, and the feeling that settled in was not just disappointment. It was total paralysis. He described it as being buried alive, as if the losses had piled on top of him like dirt in a coffin, and no matter how hard he tried, he couldn't claw his way out. This trader wasn't new. He had experience, skills, and a track record of success. But something different happened this time. The losses came quickly, followed by confusion. Every time he thought of placing a trade, his hand froze. Every attempt to re-engage with the market brought back a crushing weight in his chest. It wasn't just about the money. It was the fear that he had lost his edge, that the market had changed, or that something inside him had broken permanently. The problem wasn't the charts. It was in the automatic way his mind was responding to the trauma of loss. Just like someone who survives a car crash may flinch at the sound of brakes, this trader's brain had connected trading with danger. The market had become a threat, and the mind had activated a protective response: avoidance, withdrawal, and hyper-alertness. To help him regain control, a method was used that involved mental rehearsal and imagery. But before that, he needed to talk. In long conversations, he replayed the moments of loss. He shared how it started, how he ignored his risk limits for just one trade, and how it spiraled when he tried to recover with bigger size. The act of telling his story out loud and in detail served a specific purpose. It brought structure to the chaos. It made the overwhelming event into a sequence of understandable decisions. Then came the use of imagery to rebuild control. He was asked to visualize the same scenario that caused his fear. He had to close his eyes and mentally walk through the moment when he placed the losing trade, watched it move against him, and felt panic rise. At first, the exercise was too intense. He couldn't go through the whole scene without feeling anxiety. But with repetition and with a calm, slow pace, he was able to face the memory without being overwhelmed by it. The key was not to avoid the fear, but to confront it bit by bit. By mentally rehearsing the feared trading situation in a controlled setting, the emotional charge started to fade. The brain, exposed to the trigger without actual danger, began to learn that the fear was no longer necessary. This is how the response began to change. Alongside this, the trader created a specific action plan for drawdown periods. He built what was called a risk reset routine. This included reducing position size to a minimal level, trading only a very specific setup that had proven high probability in the past, and checking in after each trade. Not just with performance, but with internal responses. The goal was to stay connected to the market without overwhelming his nervous system. In time, this rebuilt trust. He also started journaling again, not just what happened to the market, but what was happening in his thoughts and body during trading. He noted when his breathing changed, when his hand trembled on the mouse, or when he suddenly felt distracted. The more he tracked his internal state, the more aware he became of his patterns. And awareness became the first step to control. Eventually, trading returned to him. Not all at once, but gradually, with careful exposure, structured risk, and a daily practice of mental preparation. The fear that once buried him began to shrink. He learned to anticipate stressful moments, to ground himself with breathing exercises, and to recognize early signs of panic before they grew too loud. The feeling of being buried alive didn't disappear completely, but no longer had power over him. He had tools. He had a plan. And most importantly, he had the experience of having climbed out once. And that made all the difference. Chapter 9. Transforming the Mindscape. A trader begins by facing common problems during market hours: mental noise, self-doubt, hesitation, and the inability to remain fully present. Despite good strategies and sound market understanding, performance is blocked by psychological barriers. The process of improvement begins not with changing the external environment, but by altering internal states of consciousness. This is done by accessing focused mental states similar to those found in trance or deep concentration. Through experience and study, it becomes clear that the human brain is capable of entering different modes of awareness. In certain modes, such as flow or meditation, thoughts become clear, focused, and connected to instinct. These states can be deliberately activated using structured mental exercises. Visualization becomes one of the key tools for entering these focused states. A trader visualizes the ideal trading day before it begins, seeing the charts, feeling calm, acting decisively. These mental rehearsals allow the brain to simulate experience, laying down neural pathways that match actual execution. Over time, these visualizations help improve real-time decisions by making calm, focused reactions familiar. Breathing techniques also support this process. Slowing the breath and focusing on its rhythm helps to quiet internal chatter. This quietness becomes a foundation for sharper attention. In a state of calm, a trader is better able to read markets, identify setups, and exit with precision. Breathing is practiced regularly, not just during trading, but outside of it, training the mind to return to this base state. Language patterns also shape mental states. Self-talk is adjusted to reflect positive, directive instructions. Phrases like, "I am focused," "I see clearly," and "I follow my plan" are used regularly. This language replaces doubt and fear with intention and clarity. Internal scripts are rehearsed before the trading day begins, setting the tone for how the mind will respond to market events. Metaphor is another method used to reshape the trader's mental environment. The mind is imagined as a landscape, one that can be shaped and traveled through. In one example, the trader pictures walking through a foggy field with low visibility. As breathing slows and awareness increases, the fog begins to lift. The field becomes clear, and the path forward is visible. This image becomes symbolic of clearing mental clutter and finding direction during uncertainty. Mental rehearsal extends beyond visualization of the trade. It includes scenarios of things going wrong. The trader mentally practices how to stay composed during a loss, how to handle missed opportunities, and how to reset after mistakes. These rehearsals reduce the shock of the real event, allowing the mind to respond rather than react. The goal is to train the mind to move smoothly from one moment to the next without becoming trapped in the past. Attention training is also part of the work. The mind is trained to focus on one piece of information at a time. Charts are studied not with rushed glances, but slow observations. A trader may spend time simply watching price movement without trading, learning how to observe without judgment. This discipline builds a higher quality of attention that supports better decision-making. A dedicated space is often chosen to practice these mental drills. This space is quiet, free of distractions, and used regularly for the same purpose. Over time, entering this space signals the brain to begin its shift into focus. This routine becomes part of the conditioning process. The mind learns what to expect and begins the shift even before practice begins. All these techniques, visualization, breathing, anchoring, language, metaphor, rehearsal, and attention training, are structured into a daily routine. Just as athletes prepare their minds before performance, traders prepare theirs before engaging with the market. The aim is to take control of the internal world so that it can serve performance in the external one. The more consistently this is done, the more easily these mental states can be reached and maintained during times of pressure. This approach does not rely on emotion or hope. It relies on training the mind with the same discipline that one uses to train the body. Repetition, consistency, and structure turn these tools from exercises into habits. As these habits form, the mental environment changes. Thoughts become clearer. Focus becomes sharper. Execution improves. This is the transformation of the mindscape. One deliberate breath, one clear thought, one focused moment at a time. Chapter 10. The Coat in the Closet. He sat across the room, quiet, calm, but his eyes told another story. He had just come off a losing streak in the market, and though the numbers were manageable, something deeper weighed on him. He described it like carrying a heavy coat, one that hung on him no matter the weather. It wasn't just the losses that burdened him. It was the memory of them. Every time he placed a trade, he remembered the last time it went wrong. Every chart he analyzed carried a shadow. This coat, he said, had pockets filled with regret, doubt, and hesitation. The first task was simple. He was asked to write everything down, all the mistakes, the losses, the trades he wished he had never taken. It wasn't about blaming the market or finding excuses. It was about giving form to what haunted him. The paper became a mirror. He filled it with trades, missed signals, overreactions, exits that were too early, and ones that came far too late. And as he read them aloud, something began to shift. The weight didn't vanish, but it became something he could touch, not just feel. After putting his thoughts on paper, he was told to fold it, place it inside a coat, any coat from his closet. This was no ordinary assignment. It was a symbolic act, a way to externalize the past. He took an old winter coat, one he no longer wore, and slid the folded pages into its pocket. Then he hung it back in the closet. That coat now held his trading past, his failures, missteps, and regrets. He didn't need to wear it anymore. The next step was about habits. The daily rituals he performed as a trader had to change. Instead of starting his day with anxiety over what might happen, he was told to begin with a review of strengths. A list was made, good setups identified, trades managed with discipline, exits handled with clarity. Every morning, he read this list before turning on his screens. This reminded him that he wasn't just the sum of his worst trades. He began journaling in a new way. Rather than only recording the details of trades, he included what went right in his process. If he waited for confirmation, that went into the journal. If he stuck to his stop loss, that was worth noting. The idea was to build a new narrative, not a story of perfection, but one of progress. His journal was no longer just a logbook. It became a tool for training his attention toward growth. When a bad trade occurred, and they still did, the rule was not to deny it or to obsess. Instead, he would read out loud, then write down what he learned. That entry, like the ones before, went into a box labeled archive. These weren't kept on the desk or near the trading monitor. They were placed on a shelf in another room. He knew where they were, but they were no longer in his daily path. He was also introduced to visualization. Each morning before the market opened, he sat quietly and imagined himself facing the same challenges from previous sessions. But this time, he responded differently. He saw himself waiting for the setup, managing the trade, and exiting with discipline. These mental rehearsals weren't fantasies. They were exercises in building pattern recognition in his brain, so that when the real moment came, he had already lived it once. The coat remained in the closet. Some days, when he felt the weight again, he would open the closet and touch it, reminding himself that those regrets were no longer part of his current trading. They were there, but they were put away. They didn't belong to the man sitting in front of the screens now. They belonged to the trader he used to be. As his sessions continued, so did his commitment to these actions. Each time he felt fear or hesitation, he countered it with action. He reviewed his list of strengths. He reread one success journal entry. He reminded himself that trading wasn't about being perfect. It was about being present and not letting the past shape the next decision. The process was never about forgetting. It was about relocating. Instead of carrying the coat every day, he had learned to hang it up. It hadn't disappeared, but it also no longer decided what trades he would take or how he would take them. And with that small, quiet shift, he started to trade not from fear, but from focus. The coat stayed in the closet. His hands were finally free. Chapter 11. Pinball Wizardry. He sat at his desk, surrounded by monitors, flickering with red and green. Every few minutes, a news alert would flash, charts would spike, and the trader's attention would jump like a pinball in a machine, bouncing from one data point to another, ricocheting off rumors, momentum shifts, and price swings. This trader, highly intelligent and experienced, found himself constantly reacting to the market instead of acting with purpose. His process had become chaotic, without structure. He described his mental state as being like a pinball, fast-moving, scattered, and vulnerable to every outside bump. What made the problem worse was that he wasn't unaware of what was happening. He knew he was getting pushed around by news and market noise. Still, each day, the same pattern repeated. He'd begin with a plan. Then, after the first trade, emotions would take over, and he'd chase after headlines, volume spikes, and social media alerts. He was reacting, not trading. To shift out of this reactive mode, the first step was building awareness. He started logging his trades, noting what triggered each one. It became obvious that most trades didn't come from setups. They came from external pushes, news flashes, chat room calls, or sudden moves on a chart. He wasn't waiting for opportunity. He was lunging at movement. The next step was to restructure the trading day. Instead of keeping his screens filled with every market signal, he removed excess data. He limited his information to a curated set of symbols and focused indicators. No more 5 chat rooms. No more 20 watch lists. Just a small universe that aligned with his strategy. He added brief pauses before every trade. A rule: if he couldn't explain the setup in one sentence, he wouldn't take it. This moment of reflection slowed the pinball. It made him ask, is this part of my system? If the answer was no, he stepped back. That pause created space between impulse and action. Space enough to choose. He used breathing techniques before market open, 3 deep breaths with eyes closed. He grounded himself physically, feet flat, hands on knees, reminding his body it wasn't in a crisis. He trained his body to be calm so his mind could follow. The breath became an anchor, a way to come back from the chaos. He also implemented a centering ritual. 10 minutes before the market opened, he would stand, stretch, review his plan aloud, and visualize executing it. This mental rehearsal brought his attention inward. It was no longer about chasing movement. It was about executing structure. As the days went by, this shift became more visible. His trades became fewer, but more focused. The wins were clearer. The losses were no longer because of distraction, but came from trades within plan. The mind, once jumping from point to point, now began to settle into rhythm. He also set check-in points throughout the day. At 10:30 a.m., noon, and 2 p.m., he paused and reviewed. Am I trading my plan? Am I reacting or leading? These small mental audits helped reset when distraction crept in. Even if he slipped, the structure gave him a way back. The concept wasn't about trading slower. It was about trading consciously. Just like a pinball machine needs a player with intent, not random slaps at flippers, trading needed guidance and strategy. He learned to step outside the storm of noise and reconnect with what mattered. At the end of each day, he wrote a one-paragraph summary of his performance. He asked himself what he did well, what he missed, and what to adjust. The act of summarizing kept the mind organized. It turned chaos into clarity. Over time, he saw fewer days of scattered decision-making and more days of consistent execution. When moments of high volatility returned, he stayed centered. He still felt the urge to jump, to chase, to react, but now he had tools. He recognized the feeling and responded with breath, with review, with discipline. The game had changed. He was no longer the pinball. He was the player, steady at the controls. Chapter 12. A Session at Gunpoint. The session began with a trader who had recently faced a devastating loss. He described the moment as feeling like having a gun pointed at his head, completely exposed, overwhelmed, and powerless. The trade had gone against him quickly, and instead of cutting the loss, he froze. His hands wouldn't move. His thoughts blurred. He watched as the numbers slipped further and further into the red. He didn't remember the moment he exited. All he knew was the crushing aftermath. He wasn't just shaken, he was traumatized. And every time he tried to trade again, his hands trembled and panic rushed in. He was no longer just managing positions. He was managing fear that hijacked his body like a switch. The goal was not to treat the trade as a simple mistake, but to examine the experience of fear and loss as something stored in the nervous system. The first step was to help the trader recount the trade in detail, not to relive the panic, but to create distance from it. He was asked to write out every step of the trade, from entry to the point of maximum fear, and then to what happened after. This exercise brought the experience into the open, shifting it from overwhelming emotion to a structured sequence. Through this, the trader started seeing where he had chances to act and didn't. It wasn't about blame, it was about recognition. Once the sequence was broken down, the next step was rehearsal. The trader was guided to mentally replay the same trade scenario, but with different actions. He visualized cutting the loss earlier. He imagined taking a pause, checking his breathing, and using a prepared script. This rehearsal was repeated slowly and with precision until the new actions felt mentally natural. The goal was not perfection, but preparation. By walking through the same market scenario in his mind, he created a new response pattern to replace the old one. In parallel, he was trained to use breathing techniques that could be activated during stress. One method was square breathing, inhaling, holding, exhaling, and pausing for equal counts. This was practiced outside of trading sessions first, and then during live trading in calm conditions. Over time, the technique became a tool he could access when anxiety surged. The breathing didn't erase fear, but it gave him an anchor, a way to slow down racing thoughts and reconnect with decision-making. Along with physical grounding, he was given a checklist to keep nearby during every session. It included statements like, "Am I trading my plan? Is the risk level acceptable? What would I do if this moves against me?" These simple questions acted like lifelines. In a moment of pressure, when the mind goes blank or reactive, These prompts kept the focus on process instead of panic. He practiced answering them in real-time trades and noticed a shift, not instant control, but less paralysis. Next, they reintroduced him to trading in controlled conditions. He started with very small size, so small that even a loss wouldn't trigger fear. These low-stakes trades served as exercises, not profit pursuits. Each trade was followed by a debrief where he rated his anxiety, reviewed his plan, and identified what he did right. This routine built consistency, and with repetition, it made confidence less dependent on outcome and more grounded in preparation. When a triggering event occurred in the market, a sudden news spike or price collapse, he didn't avoid it. Instead, he used the same steps: pause, breathe, ask the checklist questions, decide. Each success in handling these moments created reference points for the next. The more he responded with control, the more the mental image of the gunpoint faded. He didn't forget the trade that wounded him, but it no longer defined him. The process continued with self-recordings. Before each session, he recorded a 30-second clip reminding himself of the trading goals, the plan for the day, and how he intended to handle stress. Hearing his own voice say those words created a ritual. It was a psychological warm-up that prepared him for battle, not against the market, but against old habits that used to take over. Over time, he reclaimed his ability to make decisions under pressure, not because the fear disappeared, but because he practiced functioning despite it. He learned that performance under threat could be trained. The critical lesson wasn't avoiding the sense of danger, but learning how to act skillfully when it arises. The result wasn't just recovery. It was transformation into someone who had faced panic and now carried tools to stand tall under stress. Chapter 13. A Dose of Profanity. He was a seasoned trader, intelligent, experienced, and skilled. But after a single bad trade, he exploded, slamming the desk, shouting profanities at himself, and calling himself every harsh word imaginable. He spiraled into a storm of anger. This wasn't just frustration, it was brutal self-punishment. And it kept happening. After every mistake, he lashed out, not at the market, but at himself. The verbal assault became a ritual. If he lost, the language flowed like a river of rage. No one else heard it. No one else saw it. But in his own mind, the words echoed loudly, and they never stopped quickly. This pattern was not improving performance. After every episode, he carried the residue of anger into the next trade. His focus blurred, his judgment clouded, and his confidence wavered. He knew something was wrong. The real battle wasn't against the market. It was with the voice in his own head. That voice, sharp and venomous, kept repeating the same judgment. "You idiot, you're worthless, you'll never get this right." With every curse, his self-image took another blow. The cycle was clear. He would make a poor trade, lash out in anger, feel ashamed, lose confidence, and then repeat the same behavior again. It was a trap, not a technical one, not a strategic one, but an emotional one. And to break it, he needed to change his inner language. The problem wasn't the words themselves, it was what they represented. He treated himself like an opponent. His tone was more like that of a bully than a mentor. And that created stress, not solutions. To interrupt this cycle, the approach was simple, yet powerful. The first step was awareness. After each trade, he would pause and record exactly what he said to himself. Not filtered, not reworded, just raw self-talk, word for word. Once written, he would read it aloud, not in a voice of anger, but in a calm tone. Hearing those words out loud in a neutral tone shifted their power. The words began to sound ridiculous. The harsh judgments, the overreactions, they lost their bite when stripped of emotion. The next step was replacement. For every harsh phrase, he created a counterphrase. "You idiot" became, "You made a poor decision, but you've corrected mistakes before." "You're useless" became, "That trade didn't work, but you've learned from worse." These were not empty affirmations. They were grounded in his real experience. He had made comebacks before. He had handled setbacks. He had evidence. So the new phrases weren't lies, they were accurate. Then came rehearsal. Before each trading session, he read the new language aloud. He practiced speaking to himself like a coach, not a critic. He rehearsed encouraging responses to mistakes. So when real-time losses happened, the words came naturally. This wasn't about pretending things were fine. It was about managing the internal response in a way that didn't add damage on top of damage. There was another tool: humor. After recording and reading one of his more aggressive rants, he laughed. The intensity of the words, the exaggeration of his insults, it began to sound absurd. So he used that. He started exaggerating the rants even more, in silly voices, making fun of his inner critic. That broke the seriousness and robbed the words of their control. If he could laugh at the voice, he no longer had to obey it. Over time, this new language stuck. Not always. There were slips. There were days when the old voice returned. But now he recognized it. And instead of fueling it, he addressed it. With calm, with logic, and sometimes with a laugh. The self-talk that once crushed his confidence became something he could manage. And when his mind was calm, so was his trading. He no longer needed profanity to feel strong. He didn't need insults to feel accountable. He had a better way to respond to errors. And as his self-talk changed, so did his results. He didn't need to be perfect. He only needed to be constructive. His performance became more stable, but more importantly, so did his mind. The lesson was simple. The words you use in private shape the results you show in public. When a market pressures you, what you say to yourself matters most. And if those words tear you down, they'll take you trading down with them. But if those words guide you forward, your actions will follow. What began with anger ended with growth, all by changing the voice in his head. Chapter 14. Trading from the couch. In a quiet room, a trader sits not in front of his trading screens, but on a couch. There is no ticker running, no flashing indicators, and no breaking news headlines. Yet, this moment becomes one of the most important trading sessions of his life. He's not placing trades. He's reviewing himself. His thoughts, habits, impulses, and mistakes are now under the microscope, not the market. The idea is simple. Just like a therapist's couch helps someone understand their deeper patterns, a trader can use reflection to become their own coach. This couch becomes the place where patterns are uncovered, where the trader investigates his own decision-making. Every trade he made during the week is not just reviewed for outcome, but for mindset. He begins asking, what was I feeling before I entered this trade? Was it rushed? Was it confident? Was I following my process or reacting to noise? He starts building a structure for this self-reflection. At the end of each trading day, he takes 20 minutes to go through every trade. He notes not only the technical reason for entering and exiting, but also his internal state at the time. Was he calm, angry, hopeful, or fearful? He begins to see links between certain emotions and certain outcomes. He sees that when he's tired, he tends to hold on to losing trades longer. When he's overconfident, he risks more than usual. This realization doesn't just stay in his journal. It becomes a guide for what to correct the next day. He learns to track 3 areas each day: performance, process, and psychology. Performance shows what the result was. Process reflects whether he stuck to his plan. Psychology records how his mental state influenced his execution. Slowly, he starts identifying which days were his best and why. It wasn't just when he made money. It was when all 3 areas aligned. Even losing days felt like wins when the process and mindset were solid. He adds routines to strengthen this system. Each morning before the market opens, he spends 10 minutes visualizing his trades. He walks through his setups mentally. He pictures the market moving in certain ways and rehearses how he'll respond. If the market breaks out, he imagines himself waiting for confirmation. If a trade goes against him, he practices cutting the loss fast. This isn't imagination for fantasy. It's practice for real behavior. Just like athletes rehearse moves, he rehearses reactions. He also adds a routine for stress management. During the day, if he notices signs of tension, clenched jaw, rapid breathing, or racing thoughts, he pauses. He closes his eyes, breathes slowly, and returns to neutral. He knows from experience that good trades don't come from panic or pressure. They come from clarity. He sets an alarm that rings every hour to remind him to check in with himself. Each hour becomes a checkpoint. Is he still focused? Is he still calm? Is he still trading with intention? Once a week, he reviews the entire week journal. He looks at all trades, all notes, and all patterns. He highlights 3 things: what worked, what didn't, and what he'll improve. This habit turns mistakes into strategies. Instead of beating himself up for an emotional trade, He designs a new rule or process to stop it from happening again. Instead of guessing why he had a bad day, he uses the journal to find out the real cause. Over time, he notices changes, not just in his trading results, but in how he reacts to the market. He's no longer surprised by his impulses. He knows them well. He doesn't try to suppress them. He prepares for them. He builds strategies around his strengths and safeguards around his weak spots. Trading becomes less about guessing and more about preparation and execution. The couch, once just a place to rest, becomes his daily command center, not for trading the market, but for trading his mind. Through reflection, routine, and self-coaching, he learns to manage not just positions, but patterns. He creates a process where he holds himself accountable, adjusts continuously, and grows with each experience. In this setup, every loss becomes a teacher. Every win becomes a data point. Every emotion becomes a signal. The couch becomes the place where the trader shapes his craft. It's not therapy. It's training. It's not about comfort. It's about clarity. And clarity in trading is everything.